Good to go.
Okay. I declare open this hearing of the Senate Economics References Committee into improving consumer experiences, choice and outcomes in Australia's retirement system. I begin by acknowledging the traditional owners. The committee will conduct today's hearing via video conference, and there are public proceedings being streamed live via the Parliament's website. I remind all witnesses when giving evidence to the committee they are protected by a parliamentary privilege. It is unlawful for anyone to threaten or disadvantage a witness on account of evidence given to a committee, and such action may be treated by the Senate as a contempt. It is also a contempt to give false or misleading evidence. Witnesses have a right to request to be heard in camera. I remind all persons to please mute your line if you're not speaking. I now welcome representatives from the Super Consumers Australia. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the hands I record, please state your names and capacity in which you appear.
Xavier O'Halloran, Director of Super Consumers Australia.
And Katrina Ellis, Deputy Director of Super Consumers Australia.
Do you have an opening statement?
I do. So Super Consumers Australia is an advocate for people on low and middle incomes in Australia's super system. Our vision is for an accountable and fair super system that delivers great service and great financial outcomes in retirement. Formed in 2013, we're an independent, not-for-profit organisation and leading voice for superannuation consumers. We thank the committee for the invitation to appear today. Superannuation is one of the key pillars of Australia's retirement income system, alongside other private savings, a home and public supports. But until recently, the role of superannuation in people's retirement has received scant attention. There have been good reforms to the accumulation phase of super, such as the performance test, but there are still clear warning signs that the system isn't setting Australians up well to maximise their savings in retirement. We've elected to use today's opening remarks to focus on aspects of life insurance in super which need improvement in order to enhance member outcomes as they head into retirement. But we're happy to ask about other aspects of our submission, including our modelling on super for housing. 8 million Australians collectively pay about $6.5 billion a year for default insurance, and there are three main issues that we see with this cover. Firstly, insurance is eroding people's retirement savings and in some cases offering up poor quality cover. The cost of insurance in super for an individual ranges depending on the fund and type of cover. At one end of the range, the Productivity Commission found a blue-collar worker on a low income who's paying for death, TPD and income protection would have about $125,000 or 28% less to spend in retirement due to the cost of insurance premiums and lost investment earnings on those premiums. Default insurance in super is charged at the member level and has a regressive impact on the savings of people on lower incomes. For example, a woman aged 35 to 39 earning $37,000 can expect her super balance to be reduced by about 14% due to group insurance, and the same woman earning under $18,000 could have their retirement income eroded by 44% due to insurance premiums. Our analysis of the 10 largest funds found that at age 60, you may be paying as little as $114 or as much as $1,082 per year for combined death and disability cover. For 65-year-olds, some cover costs more than 16 times as much as a rival fund. For super funds applying stricter tests to prove disability, some super funds apply stricter tests to prove disability for over 65s, with ASIC finding that these stricter tests had a 60% claims denial rate, which is 5 times higher than the average decline rate for all other claims. The second point we want to draw the committee's attention to was the enduring and devastating impact of poor claims handling processes. People's lives are derailed by injury or illness, and their pain is compounded by insurance claims processes that are poor through their super fund. In 2023, 1 in 5 TPD claims took longer than 6 months to resolve, and this time frame is longer than the time frames committed by insurers as part of their own code of practice. Nearly 1 in 5 income protection claims took longer than the promised 2 months to wrap up. Our submission to this inquiry included some harrowing stories about insurance and super claims. For example, a woman with a complex chronic illness who'd been working casually failed very strict activities of daily living test on her TBD claim, despite quickly being approved for disability support pension. Another person from a culturally diverse community struggled so much with the complexity of the paperwork and claims process that they were forced to give up on making a claim. Super funds and insurers need to design customer service and claims processes appropriately to meet the needs of their members. These people shared their stories in the hope that they could push for changes within insurance and super and improvements. They've suffered through the claims experience and don't want others to have to go through the same thing. Finally, complaints about insurance and super are at record highs. Complaints to AFCA about insurance claims handling delays are on the rise. Complaints about delays in handling insured benefit claims in super soared in 2022-23 by 136% over the previous year, and complaints have remained at this record high across 2023-24. In 2023, the average timeframe for an internal dispute about death and TPD claims ran longer than ASIC's mandated timeframe of 45 days. We have very little insight into where things are going wrong because there's a lack of data. Insurers are closing over 2/3 of claims disputes by recording, and I quote, other dispute outcome. So we have no idea if people are getting a good or bad result from the majority of complaints about insurance claims. On top of these shortcomings, insurance and super is not operating coherently with broader supports, including the disability support pension, workers' compensation, and insurance outside of super. Processes are not aligned, and from a consumer's view, it's a maze of gaps and overlaps. The deep flaws in insurance and super are standing in the way of attempts to maximise Australians' retirement incomes. Insurance and super is falling short of community expectations, and those values are ricocheting into people's retirements. We're calling for these problems to be tackled in 2 ways. First, we reiterate the Productivity Commission's 2018 recommendation for a wholesale review of insurance and super. This review should focus on how best to equitably and efficiently support people and their families who are affected by injury, disability, illness, or death during their working lives. Finally, we urgently need mandatory customer service standards for super funds to protect people through the claims process and disputes with their fund. We thank you for the opportunity to appear today, and we're happy to take questions.
Yeah, thank you very much. I wanted to kick off with some questions around the role of super in retirement outcomes. So, and housing. So, where do you think? I mean, what are the most important elements in a safe retirement for people in Australia?
Yeah, obviously housing is one of them. We find it in our research when we look at those that aren't getting good outcomes in retirement and have elevated rates of financial hardship and financial stress. The key defining factor amongst that group of people is not owning a home. So it's clearly a huge factor. We find, for example, someone who's on a full age pension owns their home rather. Does not have elevated rates of financial stress. And so, yeah, clearly it's quite a key factor alongside having a kind of baseline income that the age pension is designed to support. Home ownership is vital to delivering good outcomes for people in retirement.
So I guess in general, I mean, your organisation is there to kind of keep the bastards honest, isn't it? In terms of trying to be a watchdog for consumers against the power of the super industry. Is that, I mean, how would you sort of describe the role of your organisation?
Yeah, I mean, in short, that is why we were established. The same Productivity Commission that I referenced earlier found that too often in superannuation policy debates, the super funds were conflating their own interests with those of consumers, and that was leading to poor policy outcomes. And so they recommended an independent consumer body be established to be a voice for consumers in those debates.
And so what about housing? I mean, what does your research show in terms of housing being central to retirement outcomes? Because the super funds don't often admit that. They more focus on, well, what role can super play rather than how important housing can be to retirement outcomes.
Yeah, so I think, as I've already outlined, it's important, but I might turn to the modelling that we have done to see,
Yeah, thanks.
what value superannuation could help deliver in terms of getting more people, renters in particular, into housing, and happy to share our reflections on, how targeted that might be at the kind of key groups that we're concerned about with that low to middle income focus. So I'll hand to Katrina to take you through what our modelling found.
Thanks, Xavier. Yeah, so we were looking at the proposal of being able to access either 50,000 or 40% of your super to buy a house, and we wanted to answer the question: so who might be helped by this? And we used the ABS survey of income and housing data, which is a really rich data set. And so we had a picture of people's income, how much savings they had outside of super, and how much super they had, whether they were single, whether they were in a couple, and whether they owned a home or whether they were renters. So we looked at renters in that group who were 35 to 45. The data set does come from 2019, so all our stuff was looking at the world as it was in 2019, but we figure a policy like this should be able to work in any time period, and it was cleaner to just keep all the numbers there in 2019. And so we used sort of standard mortgage, bank mortgage eligibility criteria to say, given this income and savings, what kind of mortgage would someone be approved for? And we compared that to a modest unit. We also looked at modest houses, but because houses are more expensive, I'll just focus on the units. And so back in 2019, a unit that was 80% of the median price was about 450,000. And so we said, okay, these renters, with what we know about their financial situation, could they afford to buy that unit? Without using super, 10% of them could. And then we said, okay, suppose they could access their super, who would actually be helped by this? Whose situation would change that they'd cross the threshold and be able to afford to buy a house? And we found that of that sample of renters in the 35 to 45 age bracket, only a further 10% would actually be helped. So 80% of the renters, either through a combination of their income being too low or their super balances too low, even with accessing super, that wouldn't be enough to help them over the line. For couples, because they can combine their incomes and combine their super, about 17% of the couples would be helped, but for singles, it was only 3% of the singles. So the vast majority of renters would be left behind by this policy. So that's what our research showed.
That's great. That wasn't really my question, but my question was more about the role of the super funds in engaging in the housing debate. So what do you make of how the super funds have engaged in the housing debate?
I mean, it's a matter for them, but yeah, as you've highlighted, they've focused more, I guess, on what people's superannuation balances would look like if they took money out to buy a home, which I think is not great comfort for someone who is unable to buy a home at the moment. I think, if we want to focus on where the problem is and engage properly in this debate, we've got to think about how we get people into homes and what the most efficient and effective ways are. As a consumer organisation that focuses on superannuation, I'd say we're not housing experts, and so be looking to other groups to talk about what the most targeted policies are to solve that problem. But as our research highlights, there is a fairly limited role we see that super could potentially play in helping out that cohort of renters. And I guess our concern within that is, as an organisation that focuses on the needs of low to middle income earners, that it doesn't touch enough of that group. and focuses on a group of relatively well-off renters and helps solve the problem for them.
Yeah. So this hearing is about mortgage offsets, not about the deposit. So I guess I'm more interested in your observation as an organisation that's designed to keep the bastards honest, as to how the super funds have engaged in what's going to be a ongoing public debate about how we can help solve housing problems for people across the spectrum. So yeah, do you have any further thoughts on that?
So in terms of using, collateral of super for housing, the only insight that we could add really is using the same modelling. We get an indication of, what proportion of the renter population would have a sufficient superannuation balance to, say, use their super as collateral to get into a house. And so, the same kind of, I'm talking the same kind of numbers. It's about 10% of renters in that cohort that could potentially stand to benefit. But as I said, with superannuation experts, the kind of implications of a policy like that on lending and structuring of superannuation investments is a bit outside of our remit, but I'm sure other stakeholders will have plenty to say on that one.
Okay, well, thank you very much. We really appreciate you making the time available today. And we will now move to our next witness. And I'm now going to welcome Jonathan Eng. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. Can you please state your full name and capacity in which you appear?
Yep, Jonathan Ung, my capacity as an actuary.
And do you have an opening statement?
Yeah, I think what I would say, look, I've been asked the question about the viability of offset account, and I think of using superannuation in an offset account, and I think there is merit in that. Statistics, I think in particular from the Australian Bureau of Statistics, already show, they're quite telling in that it shows that 32% of lump sum benefits from the super system are already being directed towards mortgages. So for me, from my point of view, there's an argument that having the offset account is, where you can park your super, simply just change the timing of the home ownership, and it really presents another opportunity or a greater choice for consumers to achieve that goal, that same goal of owning a property. I think the only other key points I would make are, look, there are obviously implementation issues, and I think that would need to be considered to achieve desirable characteristics around this super mortgage offset scheme. So, for example, designing a scheme to limit the inflationary impact on house prices, but I don't think they're insurmountable. And look, there are other issues that will need to be taken into consideration, like, there will be obviously tax revenue forgone by the government because of the fall of capital in the super system, which means there won't be as much tax on investment earnings. So I think there are issues that I put through the paper, but they're just not insurmountable. And the other thing I'd say is that, look, my paper's certainly not advocating that the super mortgage offset is a superior way of saving for retirement, but it's just simply another option that gives consumers a greater choice.
Yeah, okay. Thanks very much. Now, I just want to ask you some questions about the model. So, effectively, you're saying that if someone wants to purchase a $800,000 unit, that they would make a saving of $164,000, and
Correct.
And so the question is whether that's a viable option for someone to do, or a good option for them when taking into account the return of the super fund.
Yeah. So I think, at current interest rates, that's what that 164,000 was based on, and so that was an interest rate of 5.95%. On a net of fees and tax basis, when you factor in the 40,000 that was put into the offset account, which I don't think is like, an unreasonable amount, it comes out to a net of fees and tax return of 6.4%. And so when you think about the RBA's inflation target of being 2 to 3%, and that the typical default investment option for a superannuation fund being the growth option is CPI plus 4%, that's kind of in line with the investment objective of the standard default option.
Yeah, so the question is, who would this option help the most? Is it people in their mid 40s to low 50s? What do you think?
Well, yeah, I think people have, I guess, a little bit in their super. Obviously, the people with a bit more super savings, it would certainly help. I think what's important to, I guess, note is like putting the money in the offset account is not going to necessarily change the serviceability of the loan. It just simply allows people to pay off their mortgage quicker. So it's going to be people who can already have the savings for a deposit to purchase a place already that it will assist. So I can imagine people more in that sort of midlife bracket, middle age bracket.
Yeah, so obviously the larger the amount that goes into the offset, the larger the saving.
Correct.
Yeah, so that's a concept. So people would have to make a judgment about whether that was going to be in their interests. It wouldn't make any difference to their monthly payment, but it would make a difference to the amount of principal they're paying back. So they pay the loan off fast. That's where the saving comes in. So then, what do you? So that's a concept, right? That's a concept. So, to the downside would be that you could save on interest but lose on super returns. The upside would be that you could save more in interest than you do in actually the return of your super fund.
Yeah, and look, you'd own your home faster. And, the statistics already show that, 32% of people are, when they reach retirement, they pay off their mortgage anyway. So there's a good proportion of people that are using superannuation to purchase their home in the end anyway. So for me, as I mentioned before, it's about, bringing the home ownership forward, which, provides some psychological benefits, which hard to quantify or put numbers around. But I think there is a benefit from just owning your home and having that security, knowing that you have a place to live in.
Okay, so now let's just step through the concept about how it could work in practice. So you're in your mid to late 40s, you've got 150,000 maybe in your average balance. You've got an average home loan of $500,000, $600,000. You want to use the bulk of your super to offset your mortgage. That means that you, as you say, paid off faster, make those interest savings. That's a concept, right?
Mm-hmm.
Okay. So then, if this was something that the Parliament wanted to progress, what would be the best way to design it in a legislative sense so that it was simple, it was clean, it could be used for other purposes? Have you given any thought to legislative design features?
Well, I can imagine you'd want to, there's things around eligibility, obviously. You may not necessarily want to make it available to everyone. It might be for first home buyers only. You may also want to think about, in a typical mortgage offset account, people can do whatever they want with it. But given it's coming from the super system, you might want to make sure it's quarantined so that people can't just take money out of the offset account. It would have to go back to some other sort of superannuation vehicle once the mortgage is paid off. I think there are just elements like that where you need to design and think about it, how to make sure it maintains the integrity of the super system and it's just not a sort of loophole of being able to get money out of the super system earlier. I think those are probably the key ones that you'd want to think about.
So what would be, so you legislate a product that would be, so the money would go to the bank?
I imagine that would be like the way I'd picture is the banks would be setting up almost a different product where it only facilitates movement between complying super funds to maintain that integrity. But I mean, they're the ones that have got the systems in place, and it's more putting more restrictions around the operation of the account, I think, to make it work.
Yeah, so effectively, the super fund would be compelled to offer the product if they wanted to be in the default MySuper space, or would have to have a partnership with the bank where the bank could offset their mortgage with the proportion of super as directed by the member, and then it would be semi-preserved in that sense.
Well, I wouldn't even think they would need to do a partnership. It could almost be just another product that a bank offers, and it becomes that offset account becomes like a complying super vehicle.
Mm.
So people have portability as well, in that, you know, if they decided they didn't want to, you know, bank with one of the big four and they wanted to bank with another big four, you know, they could just transfer from one to the other. So it's not like they're locked into a particular bank with a particular mortgage rate. It still has that competitive element to it.
Yeah. Okay. And effectively, there have been many precedents, haven't there, where you've had these things legislated, like retirement savings accounts and the like.
Yep.
Okay. And what about, are there any other risks you think we should take into account or we should consider in designing a product like this?
Well, I guess it does come down to the other risk for the government thinking about it is the money's not, you know, the money in the offset account's not growing. And so when it goes back into the system, people won't have as much superannuation savings. They own their own home, which is exempt from the age, you know, the assets test for the age pension. So it could mean there could be some people that are, you know, because they're now in the home, they could be actually pushed onto the age pension. So it is something to think about. You know, obviously costing would need to be done to sort of figure out the impact of that, where there could be an increased cost of the age pension. So that's the only other, I guess, key risk.
Okay, excellent. Well, thank you very much for your evidence today. We will now actually suspend the committee while we assemble our next witness, but thank you very much.
Okay, thank you.
Thank you. Resume. And we will now hear from Ms. Michelle Levy. And I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your name and capacity in which you appear?
Oh, good morning, afternoon. Michelle Levy, and I appear just as Michelle Levy in my personal capacity.
Thank you very much. Do you have any opening comments?
Very briefly, Senator. This is, in my view, a very important inquiry. The outcomes of Australia's retirement system vitally important. But I am concerned about two things. One, I worry that we are asking superannuation funds and their trustees to do too much and more than they are equipped to do. And I also worry that in doing those things, they expose the members of the fund to quite high levels of risk, which they're, again, not really well suited to meeting.
So what do you think is the general tenor of the debate around the super funds helping or not helping with the housing problem we have?
the tenor of the debate.
Well, I mean, what do you make of the what do you make of the attitude of the super funds to trying to help the nation with this major housing crisis we're in?
So I am not sure that I'm able to speak about the attitude of the superannuation funds. I think that they are naturally nervous about the extent to which they can and should be involved in what is, I think, fairly described as a housing crisis.
Yeah.
My own view is that having a home, I would go further than calling it housing, having a secure home is a fundamental need. I think that, again, going to the point of what is it that a superannuation fund can do to help people in retirement, it's very difficult for them to do anything material where somebody is homeless, as in, I don't mean on the streets, I mean without a secure, permanent home. And I don't think, and this is entirely a personal view again, I do not think it is inconsistent with the purpose of a superannuation fund to assist people with their retirement needs to help them with housing. And that's under the existing law.
And what do you think is the most important part of a secure retirement?
Well, my view is it's a secure home. That comes before having a pension from a superannuation fund. Home, and if you are fortunate, income from superannuation to supplement or in addition or separately from the aged pension. But, I mean, the retirement income review that happened a few years ago made the point very well that our system doesn't serve people without a house. So it works well for those with, sorry.
Yeah, so you're open-minded about the superannuation funds helping with the deposit, are you?
I suppose I'm not. Again, I haven't. This isn't really my area. I do worry about releasing money from superannuation funds to have to pay a deposit for a house. I have thought about whether there's like a co-investment model between the superannuation fund and their member.
Yeah.
So I think those sorts of models might work, but again, I this starts to be outside my area of expertise. I'm a lawyer.
So, I mean, APRA has said that it can't see any situation where it would permit that under the current laws, and they
sorry, the co-investment.
Yeah. So that would take us to effectively a discussion around law reform. I mean, these hearings today are about the mortgage offset idea. Now, the last witness set out that there would be the need to design a product in law if it was to become a policy that the Parliament wanted to pursue. And effectively, it would be a legislated idea where you would have a portion of the superannuation being available for an offset, which would allow the person to own their house faster, recognising that many people are using their superannuation to pay off mortgages at preservation age. So effectively giving them an option to bring it forward. So, I mean, do you think that would be a reasonably easy thing to draft and to embed into the current system, or do you think it would be hugely complicated?
I'm not sure that it would be more complicated than many of the other things that trustees are required to do now. I do worry about complexity for the opening remarks I've made. I think the more complex, the more things that can go wrong, and the greater then the exposure to for members. So that bit worries me. I'm not sure that this is particularly complex. I would prefer myself a co-investment model because that fits more neatly into the existing regime where superannuation funds make investments. A co-investment would have to stand up on its own feet as an investment of the superannuation fund.
Okay, so in that model you outlined the fund invests in the house alongside the member's own non-superannuation money.
That's right, yeah.
So do you want to give me an example of how that would work?
Yes, so it might come late towards retirement. A person who might be able to borrow a couple of $100,000, they might have $300,000 in their superannuation account. The superannuation fund would buy a home with the member. The $300,000 would be from their account, would be the source of the funding of that loan. The member would have separately, this loan would not be repayable, it would not have interest would not be paid or rent would not be paid by the person on the loan. So the return on that loan would have to be built into the $300,000 that is contributed to the house purchase, and then there would be a co-investment, two people on the title of this property, superannuation fund. Member would be able to repay their loan on this $200,000 that they have put in. At the point in time that they want to sell their house, then the house would be sold in the ordinary way, with the superannuation fund taking their share of the purchase price and the member taking their share. Alternatively, the member would be able to increase their share of the ownership with an arrangement with the trustee over time. So that's the model that I think might be able to work under the current law. I think there are other variations of the same theme.
Yeah, okay. Would you be able to provide on notice a brief outline of that model?
I can. I'd be very happy to do so. Yep.
I think it would be helpful. We are effectively in a position where we are looking at the viability of these models. We've done a report on the deposit, and now we're looking at the mortgage offset. And with that, Senator Walsh is, I think, going to ask you some questions. Is that right, Deputy Chair?
Thank you.
Over to you.
Thanks very much, Chair, and thanks very much, Ms Levy, for being with us today, and also for all of the work that you did on financial advice reform, which is also, relevant to this topic as well. You've said that you're not an expert on housing. And I think over a number of inquiries that we've been doing on this committee, both on sort of government legislation that's related to housing as well as Senator Bragg's initiatives, there's a strong, I think, consensus view that we need to build a lot more homes.
Yes.
And that fundamentally that's going to be what is most successful for moderating prices in housing. It's a sort of a basic supply and demand equation. So I do feel like in some of the discussions we're having, we're asking the superannuation system to do a lot of heavy lifting in a space where the single biggest thing we can do on housing affordability is to figure out how to build more homes of different kinds in different locations. I noted that you talked about in your opening statement, you made some points about super funds sort of having to do too much.
Yes.
And potentially exposing people to risk. And you had some concerns that you mentioned about, releasing funds from super to either pay for deposits or effectively releasing them to banks on the mortgage offset model.
Yes. Yeah.
Are we asking super funds to just do too much to solve all of the challenges that are out there?
Absolutely, in my view. I think I look at the way the SIS Act and the prudential standards have multiplied the expectations, and not just expectations, but obligations that sit with trustees. And it actually makes almost no sense. We have a system that was set up to invest savings for people's retirements, and we are now at a point where we are asking trustees to solve really difficult problems of how people retire and have a safe and secure retirement. And that now includes, as I think it needs to, housing. I think the regulators have both looked at what trustees are doing to try to comply with the retirement income covenant and express their concern that it's not enough. I worry that it's not enough because trustees actually are not equipped to be able to do that. I don't think it's the answer isn't with a product. I think it's a much more holistic response. And so that of itself, I think, is a concern. And so I do worry about adding to that burden. I then look at the liability. I keep coming back to these are trusts. It's not a bank. They're not insurance companies. They don't have a whole lot of capital. They don't have shareholders. There are some exceptions, but largely they do not. And so that means that everything that we ask a trustee to do exposes the members of their fund to the risk of having to satisfy a liability, or there is no way of satisfying that liability. So with the retirement income covenant, for example, if there is a product that is set up by the trustee and people are put into that product and it turns out to be in some way flawed and people lose a lot of money, there is no remedy. So that actually worries me a great deal, and when I see trustees having to grapple with very difficult legal obligations.
Mm.
And sorry, I know that's not what you're asking about, but it is part of your inquiry.
Well, I think it's a fairly. I think the chair would agree that it's a fairly exploratory inquiry. So, and I mean, I think, you know, what we all need from super funds is to get good returns as well. And I wonder whether
Absolutely
some of what you're describing also enlivens the question of the, you know, how much funds are loaded up with different objectives and different liabilities, and how that might affect the certainty that they need to invest and get us all good returns.
Absolutely. And I look at some, you know, reporting obligations that are coming through for, I think it's climate, you know, risks and so on. And I look at the cost of that and I understand the need for it. I understand the merits of it. But then I say, but ultimately this is in an environment where the members pay for it. It reduces their returns. So to what extent is it that trustees should be asked to do things knowing it reduces the actual return to members because it increases the costs that are incurred by funds, and it then exposes them to liability, which then comes around to how much do they take out of the fund for trustee capital and all of those sorts of things. It's really hard. Sorry.
Yeah, and we need the, I think you mentioned this before, we need the super system to be effective so that we're not all reliant on the age pension. You know, that's what it's
Absolutely.
for.
That's
and
right.
if we're doing something that involves taking savings out of people's super balances, then, as a number of people have said on this inquiry and other inquiries, that's going to have implications for a need for government to resource the age pension as well.
Yes, yes. Except I do come back to, and I am sympathetic to the housing thing, because without a house, without a home, we are all kind of insecure.
Which goes back to how do we build more homes to make them more affordable to more people?
Sure.
And just finally, because you've mentioned the retirement income covenant a couple of times and the needs for funds to improve the way retirement income after the accumulation phase is understood and delivered, I was just interested if you would expand on what you said there. You said there are some issues, but it's not so much about the products that are available.
Yeah.
So what's your thinking there?
I think that there's been a lot of focus on product designs for many years, certainly since 2010 and, you know, Jeremy Cooper's inquiry. And we've had various attempts at law reform to try to encourage superannuation funds to design more products and life companies to design more products. And I think they have existed and they disappear. I've worked on products that have been offered for a short time and then they have to be wound up. And the reason is largely that people don't want them. And people don't want them because I think they have personal concerns and issues which are not necessarily the same as the objectives that we see in the retirement income covenant. One of those is leaving a legacy. Now, that may be an objective that the government or governments don't want to sort of allow or pursue, but it makes it really hard for a superannuation fund to design a product which then answers the needs of the objectives in the retirement income covenant and the needs and objectives of their members. And so then if you tie that to giving advice, which I think it's no surprise, I think is really important. I think giving advice throughout the life of a member of a superannuation fund is vitally important to getting them to a really good place in retirement. But if you're giving that advice, that personal advice, and the person says, actually, what I want more than anything is to leave money to my children so that they can buy a house, then the trustee is not in a position to be able to say, actually, you should take up this product that I've got here, which will, you know, make sure that you have this income drawn down over the balance of your life. These two things are inconsistent. And so that, to me, is one of the fundamental problems with trustees and the retirement income covenant, is trying to use trustees and covenants to achieve, as best I can see, an objective of government which is not shared by members. So I think that's one problem. I think the other problem is that trustees just don't have the information. They don't have the capacity or the information to do individual things. Like, you know, they're not, funds are funds. They're set up to, as I said before, invest large amounts of money to get returns. And that's what they're good at. Retirement, I think, needs individual answers and individual responses, and trustees, again, funds are not set up to do that. And so I think that's another reason why they really struggle with the retirement income covenant, because no amount of cohorting is actually an answer to the individual. I think I heard somebody give a presentation from, I think they were Aware Super, and they said, we have, cohorts. They've built cohorts, and what they have found is that they might have, two people who actually meet the model of the cohort. So everybody else is like buying a shoe, it doesn't quite fit. It sort of almost fits, but it doesn't really fit. So you want a shoe that's tailored for you, not one that kind of fits.
I think you've thrown us quite a few challenges with your evidence today, but that's what we're here for, and we thank you very much for your evidence.
Thank you for inviting me, and good luck.
Thanks, Chair.
Thanks very much, Ms. Levy, and thank you to you, Deputy Chair, for your questions. We now move to our next witness. Are actually not available, so the committee will suspend for a short moment. And I now welcome representatives from the Financial Services Council. I understand that information on parliamentary privilege and the protection of evidence given to Senate committees has been provided to you. Can you please state your names and capacity in which you appear?
Blake Briggs, CEO of the Financial Services Council.
Kirsten Samuels, Policy Director, Superannuation, Financial Services Council.
Thank you very much. Can you please provide your opening statement if you have one?
Thank you, Senator, and thank you to the committee for the opportunity to appear today. The Financial Services Council represents superannuation funds, funds management firms, investment platforms and financial advice businesses. FSC members are committed to delivering for their customers in retirement by providing products and services that optimise retirement outcomes. As you'd be aware, superannuation funds have been working hard to implement the Retirement Income Covenant, which requires funds to consider their customers' needs in retirement, creating a strategy that encompasses products and services that enable individuals to thrive in retirement. One of the keys to unlocking the best retirement outcomes for individuals is getting the settings right on the provision of financial advice by superannuation funds and advice businesses. FSC research shows that over the next 25 years, the number of individuals with complex advice needs will grow by 70%. This means that their financial circumstances, encompassing matters such as marital status, business and home ownership, private wealth, social security eligibility, and whether they have independence, means their financial affairs are more complex and require personalised advice. The FSC believes that there is no one-size-fits-all solution to retirement and opposes some who are advocating for a default arrangement or one superannuation account for life. This would not be a suitable policy for Australian consumers and assumes the government or a superannuation fund is best positioned to dictate what a consumer should do with their superannuation savings. Individuals have different goals, different family arrangements and different health needs. The number one imperative to improving retirement outcomes is accessibility and affordability of financial advice for Australians approaching and in retirement, and this is rightly a focus for the Assistant Treasurer. The committee has also begun to explore options for supporting Australians regarding their aged care needs, including aged care insurance. This is an issue the FSC has been conducting research on to understand how aged care insurance could sit alongside other insurance arrangements inside superannuation. I'm happy to discuss this in more detail with the committee if there are questions, but in essence, I echo some of the comments from Michelle Levy earlier that in many cases superannuation funds are being asked to do too much. Our research has shown that if aged care was added on top of other life policies, the cost of the reduction in superannuation balances would be in excess of 20%. In short, I think the decision needs to be made between aged care insurance as something as part of super or broader life and TDB requirements that are currently there. The committee has also been considering the trade-off between using superannuation for housing and the benefits to Australians of owning their own home in retirement. The FSC acknowledges the contribution of home ownership towards financial security in retirement, and the long-term trend in both the IGR and in other external research is that home ownership is declining. The superannuation system's primary objective, however, is to raise Australia's living standards in retirement by providing retirement income. Whilst it is achieving this goal, the level of savings for most Australians is not adequate to both fund the purchase of a home and fund retirement incomes. The FSC's position is that undermining the principle of preservation will result in less Australians having adequate retirement incomes, but not materially address falling levels of home ownership in retirement. Again, thank you for the opportunity to appear, and we welcome any questions the committee may have.
Thank you very much. So I guess this hearing is really looking at what we can do to help people get into a house. So what would you make of the role that super funds have played in the debate of home ownership?
So there are some similarities and some differences between the FSC and some of the other associations that are sort of active commentators in this space. So where I say we agree is preservation is the key to a successful retirement income system. And so we have, we obviously oppose accessing superannuation to fund a home on the basis that undermines that principle of preservation, and that will ultimately lead to less adequate levels of retirement savings to provide retirement incomes for Australian consumers. So that's the starting point. But our concern is that some of the observations that I would have from my engagement through other forums like the FSC as a representative on the OECD is that pretty much every other retirement income system that's being established at the moment in our region does have a home ownership component to their retirement system. And so my observation is twofold. One is that it is a fairly common aspect of a lot of systems, and what's driving that is that inability to access a home as a key determinant of inequality in a society isn't just uniquely Australian problem. And so I think there is probably a more sophisticated policy debate that should occur around how do we trade off the benefits of a preservation being sacrosanct with the needs of people to have a home in retirement. And unfortunately, a lot of the debate has become quite shrill and taken us further from sensible policy.
So your view on the mortgage offset is it's a bad idea because it breaches the idea of preservation?
That would be the fundamental point. The other one is we haven't actually modelled this, but the relative rate of return between offsetting a mortgage and what you would be able to achieve as rate of return through a sophisticated investment, there would ultimately be a difference there. So would people be poorer in retirement as a result of the concentration risk of having all of your retirement savings in one asset is probably the other one to take in consideration.
Yeah, and so what about the role of a house in retirement though? Where does it fit in?
Yeah, look, and so that's one area where I think it would be more sensible for the industry to recognise the importance of owning a home in retirement. I mean, not only is it a key determinant of people's security in retirement and their risk of poverty and falling, becoming homeless if they're relying on things like rent assistance, but it is also such a major factor in people's stability, people's lives more broadly. So the social factors shouldn't be ignored. So I do think it is worth recognising and respecting that buying a home and having a home is an important part of the Australian psyche for many. And the other point is that for organisations that like to ignore that or discount that when they argue against some of the super for housing policies, it's a very dangerous space for a superannuation system to be when you're talking down to your own membership and telling them that you know what is more important to them in life. And so it's one where I would hope that the industry would be able to have a more sophisticated and nuanced policy debate than we're probably currently having.
So what about the issue of people using super to pay down mortgages? How many people at the moment are using their super to pay off mortgages when they get to preservation age?
I don't know the data on that, sorry, Senator. We would take that on notice and try to look into it if you like, but I don't know it off my hand. Yeah,
I think it would be helpful because I think this is really the question about this whole idea is whether it's a good idea, whether it's viable, who it would help. And clearly the sense that I have is that there are a number of Australians who are using their super to pay off their mortgage. And this idea would be about bringing that forward. So if you're able to give us any information about how many people you think it might be impacting, that would be very helpful.
Just so I understand clearly so that we don't go off and do the wrong piece of work. So there's kind of the two cohorts I think a lot of this debate has been revolving around. One is those who continue to have mortgage debt when they retire, and so use superannuation to try to retire the mortgage debt. And then that cohort that just can't get onto the property ladder full stop, and it's about accessing superannuation to help you get onto the property ladder in the first place, but that doesn't necessarily get rid of the issue of the mortgage debt. Do you want us to look into the former, was my understanding?
Former.
Yep, okay, thank you.
The former. Yeah, okay, that's very helpful. I might just see if the Deputy Chair has some questions for you.
Thanks very much, Chair, and thanks for being there. I probably just want to try and understand what your position is on the super for housing issue. So I think it's that super should be retained for retirement income, because you've focused on preservation, but that you also just have an acceptance that housing is really important to retirement, and we need to sort of separately figure out how to improve home ownership rates. Is that?
Yeah, that's broadly correct. So preservation is critical to the superannuation system achieving its broader objective, which is to provide income to people in retirement. And if you undermine that principle of preservation, at very least with contribution levels at the level they are, it's not designed to take care of absolutely every need a person should have. And so with contribution rates approaching 12%, it's important to maintain the principle of preservation so that as many people have an adequate retirement income and improve standards of living in retirement. And so that's where I think there's broad consensus across the industry. The concern that we have is that, you know, it doesn't help for the sector to be talking down to consumers who are feeling fairly acute housing needs. I don't think that's the way to capture hearts and minds in this debate. And so if we focused on the human benefit of addressing other policy areas where housing is important, we could probably actually make sure we maintain the consumer confidence in the superannuation system by not having a we know best what is for, you know, what we know what is best for you kind of mentality.
Thank you. I think that no one really disagrees that supply is the biggest issue in terms of housing affordability at the moment. I don't think that's very contentious. I
would agree.
Yeah.
It's certainly not demand, let's put it that way.
Yeah. And I mean, I think, you know, we've run through in various sort of places with this committee the issue of supply, and we've run through in various places on this committee, you know, issues associated with, you know, who even has enough super to take out of an account to assist with the deposit hurdle, the inflationary impacts of that, the cost to retirement savings and so on. I just wonder, we may as well, you know, get the range of views on the record in this sort of exploratory inquiry. I just wonder if you have any views to put on the record around the potential role of the superannuation sector in contributing to supply through institutional investment, if it is, you know, meeting the purpose test of getting, you know, good returns for members.
Yeah, and look, a number of FSC members are also participating in the Treasurer's investment roundtables, and so are plugged into those streams of work. Look, I think the short answer is it has the potential to contribute to supply, but it can't solve supply in its own right. As you identified, often there's state-based regulatory issues or even local government issues, and with all the best intention around making investments into into property, those other areas also need to be resolved at the same time. The investments can't be made if the regulatory hurdles at a state or local government level are so great that it will push the cost of developing that or the cost of the land so high, the superannuation fund doesn't get a commercial rate of return on investments. We're strong believers that along with preservation, the best financial interest duty is sacrosanct. You cannot ask superannuation trustees to do things for altruistic reasons that are unrelated to the retirement incomes or generating retirement income for their members. And so the challenge for the government, and this isn't an easy one, don't get me wrong, but the challenge for the government is to try to simultaneously solve those different areas so that the capacity for institutional investors to come into that market can be unlocked.
Yeah. Thank you. And just on this idea, I'm not sure whether you've done much work on it yet. I think your submission does go to it a bit, but the idea of using super as collateral for a house or somehow mobilising super for an offset, which is, I think, sort of very, you know, exploratory at this stage. Do you have...
I'm trying to remember what we said on that, because I think at the time that we drafted the submission, there were a couple of different policy options floating around, and we tried to address some but not all, I think is probably the quick way of describing it. The main point
sorry to just cut you off there or sort of redirect a bit, but
sure.
I mean, there's issues around just sort of investment certainty there, aren't there? You know, funds being able to focus on the best financial interest, funds being able to direct their investments in a way that you know, gets the best returns for people. You know, funds not having to you know, be made to put investments sort of across to certain types of assets, which will limit their ability to invest more broadly. Those sorts of concerns must be there somewhere in terms of the risks of this sort of approach.
Yeah, and at the moment, a lot of these are both ideas rather than well fleshed out policies. So, but a couple of observations would be, as soon as you require a superannuation fund to either transfer or allocate some resources to a particular investment, you impact its capacity to make investment decisions in the best interest of members. So it may limit the potential returns you can get via other asset classes. The other point I'd make is we haven't modelled things like putting superannuation into an offset account for a mortgage. But as I said earlier, I would have concerns around what is the relative rate of return that you're going to get putting your money there, especially if you're in your 20s and it's going to sit there for the next 20 or 30 years, relative to a sophisticated funds management industry that we represent, that has the whole suite of asset classes to invest in and can make, you know, sophisticated investment decisions on behalf of consumers that should generate a higher rate of return. And so we would need to take into account the opportunity cost of enabling people to invest in a residential property, and especially a specific residential property in one market as opposed to residential property as a broad asset class across the country, and what impact that would have over the long rate of returns. So it's a complex issue and there are many factors you'd have to look into. I think it's something that when there are more concrete policy proposals as this committee, you know, gets closer towards the end of its work, that's where we'll be able to test these ideas more thoroughly.
Okay, thank you very much, and thank you, Chair.
Thank you, Senator.
Thank you very much to you for your evidence today. You go with our best wishes. And we now move to our last witness of the day. And basically, I now welcome representatives from Your Financial Wellness. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, please state your full name and capacity which you appear.
Alexander Hassel, co-founder and CEO of Your Financial Wellness.
Do you have an opening statement?
Yes, I do. So good afternoon, Chair and members of the committee. Thank you for the opportunity to appear before you today. As I said, my name's Alexander Hassel and I'm the co-founder and CEO of Your Financial Wellness. We've made a detailed submission to the committee, but before I take your questions, I'd like to briefly outline who we are, how we can assist the inquiry and some of the key policy measures we believe are crucial for consideration. Your Financial Wellness is an online platform specialising in data analytics and financial literacy education. We work with financial institutions across the country to enhance the financial capability of their customers. A key feature of our platform is the Your Financial Wellness Index. This was validated by the University of New South Wales as a reliable measure of Australians' financial wellbeing. Our data-driven approach offers unique insights to help institutions develop better financial options tailored to their customers' needs. With over 2.5 million people entering retirement age in the next 10 years, it's more important than ever to equip all Australians with the knowledge and tools they need to navigate their financial journeys with confidence. And as we face the largest intergenerational transfer of wealth in history, it's not only today's retirees we need to consider, but also those of the future. Our analysis has shown that financial literacy in Australia is alarmingly poor. 40% of Australians do not fully understand the impact of inflation on their savings, and less than half has a grasp of the importance of investment diversification. This lack of financial understanding is deeply concerning, especially given the clear link between financial literacy and overall financial wellness. To address these challenges, a comprehensive review of the National Financial Literacy Strategy is needed. Additionally, a government-funded financial literacy campaign modelled after successful public health campaigns like Slip, Slop, Slap or Life Be In It could elevate financial literacy to the level of everyday importance that it deserves. As the financial landscape evolves, there's also an increasing need for robust regulatory protections, particularly for retirees who are vulnerable to misleading information from unregulated influencers. It's crucial to establish clear standards to ensure retirees receive accurate, trustworthy information. We believe that these standards should also extend to financial literacy programs in schools, and that would lay a foundation for future generations. Today marks the final day of Scam Awareness Week, and it's a timely reminder of the critical role financial literacy plays in defending against financial fraud and coercion. Banks and superannuation funds have effectively raised scam awareness, and their role should be expanded to actively promoting financial literacy. We see financial institutions as a key part of the solution. Beyond financial literacy, Your Financial Wellness is committed to fostering home ownership. Our analysis has consistently shown that home ownership is not just a cornerstone of financial security, it is the single most significant driver of financial wellbeing in Australia. However, we are witnessing a shift in aspirations. Our data shows that the 25 to 34-year-old age cohort, once the bedrock of home ownership aspirations, is increasingly prioritising experiences, such as the trip of a lifetime, over the traditional goal of owning a home. This makes it even more crucial to address housing availability for those still striving for home ownership. Our analysis shows that many retirees who could help free up stock by downsizing are unaware of government initiatives designed to assist them. These programs offer substantial financial benefits, but they're underutilised, largely due to a lack of awareness. By improving communication about these options, we could unlock thousands of homes, addressing housing shortages and providing a financial lifeline for asset-rich, cash-poor retirees. In conclusion, Your Financial Wellness remains dedicated to working with policymakers, ADIs and the broader community to ensure that Australians can achieve financial wellness and independence, especially as they approach and enter retirement. Thank you, and look forward to taking your questions.
Thanks very much. I guess my main question to you is, what do you think about this idea of having a mortgage offset from the super fund?
Look, I think that it sits outside the expertise of what it is that we do in terms of delivering financial literacy education. But the scope of our data means that we can get some really interesting insights. And what we know is that people reaching retirement age, about a third of them have a mortgage. We're not quite sure what happens with the superannuation, whether it's used to pay down the mortgage. What we can tell you is from our analysis, it's around 17% of people over the age of 70 then go on to not have a mortgage. So it suggests that they reach retirement age and that money can be used then to pay off the mortgage.
So how many people do you think are retiring or getting to preservation age with a mortgage?
All I can talk to is our independent data sets. But what we're seeing is it's around a third of users of our platform. Now, they come from across Australia. A third of those people are retiring with a mortgage balance.
A third?
Yeah.
And that's at age 60?
Yeah, between 60 and 65. And one point I would like to make is that we've run a control group that looks at users of our platform versus those that aren't on our platform. And what we've found is that users of our platform have higher levels of financial literacy as well as higher levels of financial wellbeing as reported by the Your Financial Wellness Index. So what that suggests is that they're doing better than the average. So we may be underreporting it.
So what do you think is the key determinant of a safe retirement?
Home ownership. Home ownership is the single factor most correlated to financial wellbeing.
And how do you think the super funds have tried to help here?
Look, I think that super funds that are providing tools and support, such as our platform, to their members are demonstrating a desire to provide the practical education and tools to help people make better decisions. I think that there's a crucial role for super funds and financial institutions more broadly when it comes to improving and promoting financial literacy.
So with the 1/3 of people that you think are retiring with a mortgage, is there any sense of how big that mortgage might be?
I could take that on notice. We can have a look at the figures that we've got. I don't have them on hand. So yeah, I'll take it on notice.
I think it'd be very helpful if you could take that question on notice and also the size of the mortgage, because I guess what we're looking to do is to consider whether there's any options for giving people more choices during their working life in relation to this super mortgage offset idea. So
I think to that point, Senator, our database is impressive in its scope and also its understanding of people's attitudes to finances and their financial goals and aspirations. But what we need is more data. And I think that promotion of financial literacy programs that meet a certain standard would greatly inform policymakers.
Yeah. Excellent. Okay, well, thank you very much for your evidence today. That's all the questions we have for you. We requested answers to questions on notice be provided by Tuesday, 10 September. That concludes today's hearings. Thank you for all witnesses who appeared and to Hansard Broadcasting. The committee is adjourned.